The Fed just held an emergency undisclosed meeting with the banks about stress in the repo market behind closed doors at the Fed's annual Treasury Market Conference. An urgent, unscheduled, hastily arranged meeting unfolds with Wall Street's top players. This happened just days ago without any public notification until the story was broken by the FT on Friday night. What in the world is happening? So it is unavoidable. There is stress in the plumbing of the US financial system. Now, how did we get here? Well, here we're looking at the Fed's balance sheet. Remember that they have been engaged in quantitative tightening. That is a negative for dollar liquidity, just as QE, where the Fed balance sheet goes up, is a positive. Not only that, the reverse repo has been dwindling. Now, think of this as a shock absorber for excess liquidity in the US financial system. At its peak, about $2.5 trillion, now just $1.5 billion. Not only that, but the Treasury General account, the government's checking account, has been being built up from a balance of about $320 billion to about $940 billion. Well, remember what that means is about $600 billion has been removed from the financial system and put in the government checking account. Now, in fact, when we started to cover this growing liquidity strain, the Treasury General account was at $364 billion back in July, back in August. And of course, the chart that everyone is showing now, back in July, we warned that this would be exactly what happened because it is pretty straightforward. When you are engaged in quantitative tightening, the Fed's balance sheet is being reduced. That's a negative for bank reserves. That is the monetary base for the US financial system. And of course, that storage tank for excess dollars, the reverse repo, the shock absorber, that has been dwindling. So when the Treasury goes to build up its Treasury General account, the money has to come from bank reserves. It cannot come from the reverse repo. It's got to come from bank reserves. And not only that, but we are running massive 7% of GDP deficits, meaning a huge amount of debt must be issued just to keep the government running, just to keep the lights on. So what we get is a building liquidity crisis. Now, SOFR is the secured overnight funding rate. That is the cost of capital on an overnight secured basis. And what we're looking at here with the red and yellow line is a spread between two different interest rates. Now, everyone has seen this chart. Here is the way that the Fed sets the overnight price of money, or tries to. Normally, as we can see, SOFR, the actual cost of capital, bounces in between this range. Now, what we have been seeing recently is the Fed is starting to lose control over that actual cost of capital. Remember, if you are the only firm on Wall Street with $100 billion of cash and everyone is coming to you needing cash, you get to set a very high price, a very high interest rate. And what we can see is it is not only SOFR, it is not only the $3.1 trillion SOFR market that is seeing stress. The federal funds rate, which is unsecured overnight lending, very similar concept, but unsecured interbank overnight lending, that interest rate has actually been ticking up. If you'll recall, go back to, say, February or June, you can see the Fed funds rate was right in the middle of IORB and the reverse repo award rate, right in the middle of the Fed's range. But what we have been seeing recently is that Fed funds rate has been ticking higher relative to the reverse repo and is dangerously close to IORB, which is the ceiling that the Fed tries to set for unsecured overnight interest rates. Now, for secured, they use different tools. They use the discount window and the standing repo award rate. And as we can see, that's 4%. Well, for Thursday's data, SOFR came in at 4%. As you can see, it has been ticking above the upper bound for 6 consecutive days. In fact, going back about a week and a half ago. Now, I want to update the timeline here. 10:14, Jerome Powell, chairman of the Fed, comes out and he says liquidity is tightening and talks about firming repo rates, what we were just looking at. Now, normally the chairman of the Fed doesn't talk about something as wonky, as nerdy, as boring as SOFR or SOFR spreads. Then the next day, the Fed released a report showing that the basis trade, this highly levered 50 to 1, 100-to-1 levered hedge fund trade, is actually $1.8 trillion large. And oops, we undercounted the Cayman Islands by $1.4 trillion. And the reason the Cayman owns so much U.S. Treasury debt is, of course, because of all the hedge funds there. The country only has a GDP of like $7 or $8 billion per year. Then, about a week later, Lori Logan, the former Soma manager, who Soma is the Fed's balance sheet. The vast majority of the Fed of Soma is the Fed's balance sheet. Basically, the Fed's balance sheet comes out and says asset purchases must return if repo rates don't come down. Those SOFR spreads that we were just looking at. Then, about a week and a half later, Roberto Perli, the current Soma manager, comes out and says reserves are no longer abundant. Then, that same day is when this emergency, impromptu, hastily arranged meeting, I think those are pretty nice euphemisms, with the primary dealers. And what they talked about was the use of the SRF and liquidity strains in the plumbing of the financial system. Then, the next day, the Federal Reserve Bank of New York, that is the operational arm of the Fed, posted the following chart showing a surge in hedge fund borrowing via repo. As we can see, about $3 trillion in terms of the amount of repo borrowing. And by the way, the same day, SOFR once again hits that upper bound of 4%, as we can see here from this chart. But again, remember, it's not just SOFR that has been ticking up over the past couple months. Again, this has been obvious going back to July or August, even though very few people were talking about it back then. It was obvious that this would be the end result. And to some degree, this is what the Fed wanted. They were trying to tighten liquidity at the end of the day. Now, as we can see, quarter end, tax deadline, these are normally very important dates when it comes to liquidity, and funding can be tight. And we'll see SOFR spike, but then it comes right back down. Well, what I want to point out is recently we have been seeing not only SOFR spike above the reverse repo award rate, getting to the upper bound, in fact, spending 6 days above the upper bound about a week ago. Not only that, but the unsecured lending market, the Fed funds market, the interbank overnight market is also seeing signs of stress as well. We can see Fed funds ticking up 5 basis points. And again, it is just 2 basis points away from the Fed's upper bound for the overnight cost of capital. Now, here's another way to think about it. This is the reverse repo level minus the standing repo. Now, the standing repo is the Fed's emergency liquidity backstop. That is what this meeting was about, increasing the usage of the SRF. Then in green, we can see bank reserves inverted. So as the green line is going up, bank reserves are going down. And then finally in yellow, we are looking at SOFR minus reverse repo. That was the chart that we were looking at before, this moving average of a SOFR spread, again, indicating the relative tightness of liquidity. And as you can see, when bank reserves go down sharply, as we can see here, SOFR spreads go up sharply. The correlation here is pretty obvious. And by the way, the repo rate crisis of 2019, it happened under identical circumstances. The Fed was engaged in quantitative tightening, meaning bank reserves were declining and getting more and more scarce until eventually liquidity was so scarce that it caused SOFR to go 900 basis points above the Fed funds rate on an intraday basis. And again, the Treasury General account, when we first started talking about this all the way back in July, the Treasury General account was only $360 billion. It has been built up by about $600 billion. Now, the reverse repo has also declined. When we started talking about it, the bounce was about $100 billion. Well, it is down to basically empty. And the Treasury General account, the government's checking account, has been being built up, meaning liquidity has been removed from the financial system, from the banking system, and reserves are no longer abundant, as Roberto Perli said. Here, by the way, are some of the headlines from his speech at this annual conference back on 11/12. Now, not only that, but again, Lori Logan, here are some of her comments back at the end of October, again, when SOFR spreads were really getting unruly. And by the way, here are Powell's comments I had mentioned on 10/14, the day before the Fed released a report showing that the basis trade is $1.8 trillion large. They point out it's financed in the repo market. So again, if repo rates start to spike as they have been, we can see that from the moving average. I'll take off the day-to-day spread there so you can see the 10-day moving average. It is abundantly clear that liquidity is getting more scarce. So what was this meeting about? Well, it was about encouraging the use of the standing repo. Here is a chart showing that standing repo facility. By the way, I will link the FT article in the description. It is unfortunately behind a paywall, so I can't go through it. I believe that's a violation there. So unfortunately, I can't review it with you. But suffice to say, it's a lot of the same things you've been hearing from this channel for about 4 months now regarding tightening liquidity in the repo market and, of course, the standing repo, which is one of the Fed's tools. Now, remember, there is an interest rate on the standing repo. If we go back to this chart, we can see that interest rate is 4%. So you wouldn't expect SOFR to go above the discount window or standing repo rate, but it does. As I mentioned, 6 consecutive days here about 2 weeks ago where SOFR was above the Fed's upper bound, again, indicating the Fed has lost control. Well, why might that be? It can be due to stigma. So not only discount window stigma, I will also link this article in the description as well as this one, which is specifically about the standing repo. They mention the stigma here as being one of the top concerns for various institutions when it comes to using the Fed's standing repo facility. So the standing repo is basically an emergency liquidity backstop. And as we can see from this chart straight from the Fed, it has been getting tapped to an increasingly frequent and increasingly large degree, spiking here on the 31st at a total of about $50 billion. So the need for liquidity is obvious. We can see that, at the end of quarter two here back in 2025, there was about 11 billion of SRF usage, but then nothing after that. It immediately calmed down after that quarter end stress abated. Well, what we're seeing now is the exact opposite. This is persistent stress, again, as I pointed to with the moving average on the SOFR spread. So the Fed meeting here, I think the timeline, again, indicates that there is something significantly wrong. They are trying to warn everyone. Now, remember, if this turns into a crisis, I'm not saying that it will for sure happen, but if it did, like the 2019 repo rate crisis, the end result is the Fed injects liquidity. How do they do that? They print bank reserves, again, the monetary base. They print those out of thin air digitally, and then they inject them into the banking system by buying financial assets like mortgage-backed securities or U.S. Treasuries from the bank. So if this ends up becoming a crisis, like it appears they are trying to warn everyone that it might be, that is the end result. The end result is always QE. It is always financial stimulus. Again, I will remind everyone that inflation is currently at 3%, and financial assets are at an all-time high. Now, I will point out that as SOFR spreads have become more elevated, as some of these comments have been coming out, we have seen more volatility from equity market, from the bond market, and from the DXY. So I would keep an eye on all three of those. I would also keep an eye on the newswire because, again, they seem to be trying to tell you that liquidity is becoming scarce and it could turn into a crisis. Again, I think this timeline speaks for itself. So again, watch the DXY dollar index, watch U.S. Treasury yields, and watch the equity market, as well as, of course, SOFR spreads. We will continue to cover it as we have been going back to July and August. So you can always tune in to find updates on this. It's become almost an obsession of the channel. But at least everyone is now educated on how the plumbing of their financial system works, hopefully. So anyways, hopefully that was helpful, and I'll catch you in the next one.